Okay, so welcome to yet another class of financial accounting, where we try to look at different aspects that help you to prepare for the coming exam. So we have a paper here. This is March 2021. So we have instructions here, which you always find on all at least your CPA papers, but they vary according to a paper. As you can see, you're supposed to do section A and section B, and section A here is bound separately. Section A, they are multiple choice questions, and you should attempt all. We have some multiple choice questions. At least you should have seen how these are set. But like I continue to emphasize, for you to best prepare for same or choice questions, you need to understand accounting in depth, because the examiner will just use the same things that are within your notes to craft, let's say, different objectives, and yours is to choose and select the right answers. For example, just like the way we have depreciation, the examiner can be able to just put, let's say, give you the useful life, give you the cost, and give you the scrap value, and then asks you determine maybe the depreciation. And then they go ahead to give you A, they give you maybe 200 million, 3, maybe 100, 4, maybe 50 million, and then you have to choose the right answer. So that is exactly what happens. Or they may bring something to do with, let's say, maybe provisions, and say maybe A had maybe over 200 million in account receivable, and it provides for 5% of its provisions for bad debts. Then they ask you determine the double entry that you need to use in recognizing the provision. So, and then they give you different objectives. So it's not that complicated, but I would encourage you to find some of these objectives. You can find them. We have some of them, so you can be able to reach out to me, and then I can share some of them with you. But you can also find many of them on the iSPAO website, just in case you have registered. Okay. And then, of course, section B, for it requires you to do 4 questions of the 5 questions, and each question carries 20 marks. Now, definitely, as a part of the strategy, yours is to make sure at least you have maybe 15 out of 20 for section A, as well as choose any questions of the 5 questions, choose at least 4 questions where you can at least get a 15 and above. And as you can see, it's only 1 question that you leave out. So every topic really matters along your journey for the CPA. So we have this question. This is, like I said, this is March 2021. And this question 1 would help give us more information around preparation of financial statements, especially for the private sector. Okay. Of course, one of the things that you need to understand is that we have what we call different business entities. Okay. And these different business entities also have, let's say, different business entities have different ways of how they prepare their financial statements. Okay. So, and this forms part of what you exactly study. So we know that we have the sole traders, we have the partnership, and then we have the limited liability company, like the question that we basically do have. So you need to be able to understand what kind of business are you preparing for. If as we proceed, you get to realize that partnerships have totally different accounts of how they look like. A sole trader is somebody who is really who has no accounting system, who has maybe no accountant even in place. So things like maybe single entry and single entry accounting and so on would be so much common with a sole trader and so on. Okay, so you need to understand how each of them play. Of course, in the notes, you'll be able to get information more about what are the advantages of each of them over the other, just like the way a sole trader could be. And some of the advantages think about is that this is like that side shop just in your neighborhood. It's one of the advantages. It's quick and inexpensive to establish. You can just use a very small amount of money and you're running a sole trading business. Okay, and then also not being subject to company regulations and so on. That could also be one of the benefits. Also benefits around decision making. You can be able to make your own decisions as an individual without consulting people like we do in partnerships, because partnerships come with different partners, as well as you cannot have to really struggle because it's within your mandate to take such decisions and also benefit from any profits that come through, as well as being able to also bear losses, okay, alone, which will also come as one of the liabilities with them. And that's why they usually, one of their key advantages here, disadvantage here is unlimited liability. One of the things that comes with companies, every time you see a company that has LTD on it, it means that that company has limited liability. And what limited liability basically means that in case that company, let's say, goes into maybe solvency, or it becomes, let's say, it is liquidated, it means that the shareholders' liability is only limited to their capital contribution. Okay, the shareholders' liability is only limited to the capital share contribution. So they will not tap on their properties, personal properties. They will not tap on their other companies and so on. And that is why you see there are many companies that are running as LTD, because in that way, those companies are a separate legal entity from the owners. Okay, so, and those are of course the most companies. Now, just like the way we have the LTDs, okay, which could be private, we also have what we call the public limited companies. Okay, and for a country like Uganda, the public limited companies are those that you continue to see on TV during the times after news, where they're telling you about how their shares have gone either high or low. And that's one of like MTN is also now joining that lane. So companies like New Vision, companies like DFCU, companies like BAT, companies like CIPLA, companies like Uganda Clays, all those are public limited companies. So what happens with public limited companies is that for them, they have many shareholders and they list on the stock exchange. Okay, so as an accountant, you need to understand each of them, from the sole trader, understanding how partnerships work, and also understanding how limited liability companies work, and understanding that limited liability companies can either be private or public, and what distinguishes between them is very important for you. Okay, of course, partnerships, as even we proceed and continue through our study, the partnership, the key aspect here is that it's more than one person business, and is what governs them that is called the partnership agreement, which sometimes this could also be called a partnership deed. Okay, so it's very important that you also understand what is embedded within the partnership agreement. It's just basically terms and conditions that partners agree together to say, this is how we are going to run our business, this is how we are going to share our profits, this is how we are going to recruit other new partners, this is how we are going to, let's say, maybe handle losses, this is how we will manage exit, this is how different things that they may need to agree upon, who is going to get a salary, who is not going to get a salary, who is going to be active in the partnership, who will be, let's say, dormant, and so on. So it's just basically a guiding document to help them be able to move forward. Okay. Now, one of the things that you also need to understand with partnerships is that partnerships have unlimited liability. Okay. And by unlimited liability, I mean, just in case any kind of loss or any issue basically happens, the partners individually are liable. Okay. The partners individually are liable. And this whole aspect of partnerships is very common, especially in the accounting profession. And that's why you see people who run auditing firms, they run them as partners. Even the big four audit firms, you find that they are inclined onto the different partners that are actually behind them. And that's why you see a partner will sign off financial documents, those accounting financial documents, with it in mind that just in case any kind of signing, whoever makes decisions on those financials, they have the confidence the partner has signed, so that in case of anything, the partner is actually liable, okay, individually. So you need to continuously understand of how each of these play, as well as understanding what are the advantages. Why would I choose a partnership over a sole proprietor? Because the examiner could just come and ask you, explain the different, maybe the different composition of the partnership agreement or partnership deed. Maybe we'll go ahead to ask you, give the disadvantages of partnerships, okay? And you know that every time you're looking at, let's say, advantages, in the same way, especially when you're looking at each of the business structures, yours is to continuously compare them with each other. For example, if I'm looking at advantages of partnerships, I could be looking at, let's say, a limited liability company or a sole trader. If I'm looking at a sole trader, I know that advantage of a partnership is that you are more than one, so you're able to contribute more capital than an individual that is on a sole trader business, okay? So you could also think about, like, let's say, where maybe you have a loss, at least it's not only one person who bears the loss. There's also better decision making, because one person gives an idea, the other person supplements it, and at the end of the day, you have a better idea, okay? So you need to look at it from that angle. And as you can see here, this first point of relatively easy and simple to set up, this is now trying to compare it with the limited liability company, which may take you steps to apply from reservation of name, preparation of the memorandum of that, and that was of association, and so on. And also when you compare it with, let's say, like the public limited company, where you have to even issue a prospectus, okay? Just like the way we are seeing MTN issuing a prospectus and going through all the phases, the IPO, and so on. People may just choose to do a partnership, which is much easier to open up, okay? Just like the way, so it's an informal business structure. There are no accounting standards that rule it as it runs. So on and so on. And even when you come to disadvantages, still you'll find that they are trying to compare it with, let's say, the advantages of other business structures, okay? So these are very key. And even when you get down to let's say your syllabus, the examiner tries to take into that consideration that these are part of what exactly you need to be exactly knowing. So you'll be able to find more notes on that. I think you can see forms of business entity is a very key part of our course outline here, even as you continue to do your study, okay? And like I said, the reason why you study about all these is because you need to understand the entities even before you can prepare accounts for it. You need to understand the dynamics of how it works before you can best prepare accounting information for it. So when you look at this question that we have been given to us, which is basically Kilungi Limited, you know that this is now a private limited company. So they're telling us that Kilungi Limited has provided the following information for their ended 31st December 2020. And they have given us this information. As you can see, it looks like it's in the format of a trial balance, because we can see details, then we can see debit, and then we can see credit, as you can see right there. So we have net profit, which is 905, okay? As you can see, this net profit is basically, this must be net profit for the year, okay? This must be the net profit for the year, because we already also have here retained profits at 1st January 2020. retained profits at 1st January 2020, which we've been given as 87,540. Okay. Now, it's not by surprise that you see net profit and retained profits having a credit balance, because this is net income. It's basically your income less your expenses. So whatever remains is basically a credit, and income has a credit balance. So that is why we are seeing it on the credit side. And the word retained profits is also the same meaning as retained earnings. Okay. Retained profits, the same thing as retained earnings. Sometimes they may call it accumulated profits. Okay, they may call it accumulated profits. And you know very well that if we are looking at a nanny for profit, this retained profits, it's called the accumulated. It's basically it's accumulated surplus, or whatever you might want to call it in that way. And then we have the cash and bank. Okay, as you can see, cash and bank has a debit balance here. We also understand that there are times also when bank can have a credit balance, and in that case, bank will be an overdraft rather than being an asset. Okay, but right here, cash and bank is giving us this balance. So this must be maybe coming from our cash book and so on. And then we have inventory at 31st December 2020. So this is our closing inventory, because our year ends on 31st December 2020, which is 45,507 on the debit side. Reason being is because it's an asset. Then we have the trade payables, which is 100,357. Trade payables, like we continue to say, these are your liabilities, these are your creditors. Okay, and these are basically suppliers to whom you have bought things on credit and you're yet to pay. So they are basically liabilities, because liabilities have a normal credit balance. Then we have investments. Now you find that companies do make investments, and this could be an investment maybe in another company, or maybe having shares in another company. For example, if I'm running a company right now and I make a decision to get shares in MTN as a company, that will be my investment. So investments are also assets in themselves. Okay, so you need to understand that. Then we have allowance for bad debts. Now, allowance for bad debts is the same thing as provision for bad debts. Okay, you need to basically know provision for bad debts also has a normal credit balance, as we have seen. Then we have share capital, which they are telling us that is at 1 shilling each, and then they have given us this value, so you can be able to determine how many shares you have based on this information. Then we have the share premium. Now, I just want to explain something very small on share premium. Share premium comes in when shares are traded at a price higher than their market value. Share premium comes in when shares are traded at a price that is higher than the market value. A case in point, in case my share is worth 1,000 shillings, and we basically issue out shares at 1,200, we'll basically recognize how much we earn from the shares, and partly some amount will be posted here and another amount will be posted here. Now, the share premium takes the 200 times the number of shares we have sold, because that is the share premium component of what we have issued there. So it's something that you need to take into consideration to understand that share premium is basically an account that records any excess in terms of the value of the shares that is sold above the market, above its market value, may not be necessarily market value, but above, let's say, the nominal value, okay, of the share. And then we have the trade receivables, which are your debtors. And with debtors, you know very well that these are assets, and that's why they are being recorded there. Then we have the revaluation reserve. Revaluation reserve is basically you as a business, sometimes we do what we call, we revalue our assets. Okay. Now, why would you revalue your assets? You revalue your assets because their value, their carrying amounts may be lower or higher, than the actual, let's say, actual market value of those assets. Now, why this comes up, it comes in up because we have depreciation. Now, if today I buy my motor vehicle, let's say worth maybe 10 million, and I say that because of this vehicle, I'm going to be depreciating it, let's say 1 million every year. I've bought it 10 million and I'm going to depreciate it 1 million every year. So it means that if it's in the 8th year, I would have depreciated this vehicle worth 80 million because I'm depreciating 1 million every year. So what this means that the value of my vehicle would definitely be the 10 million that I bought it, which is my cost, less the accumulated depreciation, which will be 8 million in the 8th year. So it means that this vehicle will actually be worth 2 million. But I'll ask you that there are many vehicles that were bought, let's say 10 years ago. And when you look at it, you cannot even value it 20 million. The vehicle is way much better and it's running. So once you get that point as, let's say, an accountant or as a business owner, yours is to relook into your assets and revalue them onto what would be the actual value of what is in the market. So this amount of money, when each time we revalue an asset, let's say an asset has increased in value, okay, maybe its actual value outside in the market is way higher than what we have it in our books, we'll definitely do what we shall debit the asset and then credit our revaluation reserve. Okay, we shall debit the asset and then credit our revaluation reserve. So the revaluation reserve we'll keep in our books, and as you can see, it has a normal credit balance because every time we are revaluing our assets, let's say we are debiting our assets and then crediting at the revaluation reserve. So continuously to have a normal credit balance. And then we have the land at cost, which we have been given. Also to know that land is a non-current asset which does not depreciate. Okay, so they will give you this, and the way you have seen it here, unless any part of it was sold off, would definitely take this to our statement of financial position as it is without any associated depreciation. And then we have the motor vehicle at cost. Like I said, whenever they say motor vehicle at cost, means that this 230,504 is the amount of money that we incurred in bringing this motor vehicle into operation, including its purchase price. Okay, the purchase price, the freight costs, the buying the number plate, the registration, and so on. As long as any cost that is incurred before the actual use of the asset, any cost that is brings in the asset into operation would definitely form part of the cost. But we also appreciate that there are also other costs that we exclude, and costs like fines, in case you have any fines that you've incurred along the way, like maybe your RA fines, those should not form part of your asset value. Okay, those should be expensed within the statement of comprehensive income. Also, if you have, let's say, what we call the refundable taxes. For example, if I'm importing a vehicle, maybe from let's say Dubai or wherever I'm buying this vehicle, and this vehicle is worth maybe 200 million, and on the border I incur, let's say, maybe VAT tax of 10 million. Now, if this VAT, VAT is a refundable tax to companies that are VAT registered. Okay, if that is the case, then the 10 million of VAT will not be considered as part of the value of the asset. But if in case I've, let's say, incurred a tax like an import duty of, let's say, 10 million also, I'll recognize the 10 million in addition to the 200 million, and now it will be 210. So 210 will be the value of my asset. But the 10 million, I'll exclude it, the one of the VAT, because in reality, that 10 million is actually refundable by URA. How I refund that? I refund that by preparing my tax returns and including that other 10 million within my within, we call it input VAT tax. Okay, you'll be able to understand that more when you get to the taxation paper, or if you've already done it. I believe that you can be able to get an idea of what exactly I could be speaking about. So when we have the accumulated depreciation, this accumulated depreciation can also be called provision for depreciation. Okay, so if you go to a paper and you're seeing the examiner calling something provision for depreciation, then that should be able to open your eyes and know that this is basically what I need to basically consider. And then we have what we call computers at cost, which is 65,400 or 65,400. I've already explained what cost means. Plant and machinery at cost, and then dividends paid at value. And then we have the 18% loan repayable by 2027. This is, of course, a long-term loan, which is a long-term liability or any current liability. Of course, dividends paid. Dividends, basically, this is a reward to shareholders, okay? And as you can see, we've been given an amount there, and then definitely this relates to the assets. So that's the information that they have given to us. And then they go ahead to give us now our additional information. Now, like I said, this is like a trial balance, and it's not by surprise that we are seeing it being able to balance here, okay? Yeah, in case, of course, it doesn't balance, we have a suspense amount there, and then we need to correct errors, but this one has been able to balance, so we can be able to proceed with the additional information. So additional information goes to say that the senior accountant of Kilungi Limited was on annual leave. The assistant accountant determined the net profit reflected in the trial balance, but had not taken into consideration the following, okay? So it means that we have to adjust our net profit, because whatever is below is not part of this 905,000 up here. So we see, we move, they go ahead to tell us that the amount of inventory as at 31st December 2020 of shillings 45,507,000 was used in determining the cost of sales. Further information revealed that part of the inventory that had cost 6.7 had a net realizable value of 4.5 million. I repeat, the amount of inventory as at 31st December 2020 of shillings 45,507,30 was used in determining the cost of sales. Further information revealed that the part of the inventory that had cost 6.7 had a net realizable value of 4.5. Now, one of the things that you need to understand about inventory, that inventory should be valued at the lower of cost and its net realizable value. Inventory should be valued at the lower of cost and net realizable value. Now, when they say cost, it means that that is how much we incurred in bringing that inventory to where it is. If we are a company that is manufacturing, that is our total production cost for that inventory, okay? And that is its cost. If we are a company that is into buy and resell, it means that that is how much we bought that inventory in addition to the cost that brought that inventory into our premises. That is the cost. Now, net realizable value, you're basically looking at how much you earn from that inventory less the costs to sell, okay? Net realizable value means basically what is the value of this inventory in the market, okay? Now, the reason why we basically value our inventory at the lower of cost and all the net realizable value is because we don't want to overestimate our inventory or overvalue our inventory compared to how much we can really earn from it, okay, from the market. And that's why if the net realizable value is lower compared to the cost of inventory, then we should actually take the net realizable value, because that is the rule as per IS2, the standard that regulates inventory. So we should take the net realizable value. Now you'd ask yourself, Now, what if the net realizable value is actually higher than the cost? In that way, we should take the cost. The reason why we now take the cost in this case is because we have not sold this inventory. So we cannot be excited and think that yes, since we cannot get, we are going to get more, maybe the market value of this inventory has gone high, then we should actually value it at that, because we also understand that selling inventory is not something that just happens in maybe very that easily, because they have competition, we have obsolescence of these products, they can get spoiled and so on. So that's why the standard comes out and says, every time you have inventory on your balance sheet or statement of financial position, make sure that you value it at the lower of cost and net realizable value. So this inventory that we've been given here, where they're saying that part of it, which is 6.7, had a net realizable value of 4.5, it means that we have to adjust it from 6.7 and value it at 4.5, okay? So we basically, what we are going to basically do now, before I can proceed and maybe to do this concurrently, one of the things that you need to understand is the examiner is asking you for the adjusted net profit, okay? And then they're asking you for statement of changes in equity, and they're also asking you for the statement of financial position. Now, each of these items, which they are telling us that happened after or were not reflected when we are calculating the net profit, it means that we have to adjust our net profit, okay? So I'll basically try to borrow the use of Excel. I'm going to basically do the use of Excel to be able to calculate our adjusted net profit. So I'll just call this adjusted net profit. Okay. So I'll start with profit brought down. This profit that is brought down, the one that we already have, okay? And then I'll keep on adjusting it accordingly. So when I come to here, I'll just go and get the profit that is brought down, which is 905, okay? That is the one that they have calculated. This is 905, and I'll put these amounts. They are shillings, 3 zeros, okay? Maybe just to put a heading here, you put this is you know, you need to make sure that you're naming this as per the company. So let me just try to name it as Kilunji Limited is adjusted net profit for the period ending 31st December 2020, like that. So this is the balance brought down right there. Now, when we are adjusting this net profit, of course, we have items that we are going to add back. We have items that we are going to add back, and then we also have items that we are going to less. Okay, just created some space there to make sure that I can be able to add and less according to what I have. So I want you to be very attentive here as we try to see how we are going to affect our net profit, okay, for this. Now, if you have this information of, say, they're telling us that inventory needs to be revalued, and they're telling us that it was had a cost of 6.7, and then now there's a net realizable value of 4.5. What we basically have to do is we have to remove this 6.7. Basically, we are going to remove this 6.7 from our value of inventory, and then what we shall basically do is we shall now add back the 4.5 on our inventory. Okay, so I'll just come right here and I'll just maybe have a tab for working. Okay, and this could be my working one. So I have inventory, and the balance brought down for this inventory has provided from the information. Just try to get it. It is 45 bis. That is the value of inventory, which is our balance brought down. So then we have now to adjust. So what I'm going to basically do, because they're telling me that there is inventory which is worth 6.7 million, that has now become 4.5. Okay, so I have two ways of how to basically handle this. So I can get this. Okay, I can get the difference between this and this, and that is what I adjust this. Or what I'll basically do is I'll less the 6,700,000. Just try to do this. I'll less the 6.7 and add back 4.5. Okay, so just to reference back and just confirm that it's 4.5 and 6.7. Yes. So what basically I'm doing right here, once I do that, okay, then I say maybe adjusted inventory balance. So what this would basically give me, this one I'm lessing and put that. I try to basically get this minus that. Okay, so that would say add, since already it has a negative onto it, and then add this, it will get me to 43,307. So what this means is that I've removed inventory that is worth, and I've added the right value, which is 4.5. Okay, for this same inventory. So that is what I've been basically been able to. Like I said, I can find ways of how to do this much better, and what I may just try to do, since they have told me that there is inventory cost is basically 6.7. Sorry, this is 6.7, and then net realizable value is 4.5. What I'll basically do, I'll get the difference, which is this minus this, and then it is this that I adjust onto my inventory, and I do that by lessing this 2.2. When of course, if I have my adjusted inventory value here, if I get okay, I can say that my balance brought down is basically this, and then my adjusted will just be this 45 minus this, which gives me 43. So it still gives me the same answer. And I believe that you get the principle, because at the end of the day, what I'm trying to do, I'm trying to make sure that I adjust this 6.7 inventory to now 4.5. Okay, so mathematically that should be the case. Somebody says here, please, I thought we are going to calculate the cost of purchase, but I haven't got you on the inventory step. I don't know what we are trying to get. Okay, I want you to basically try to follow through here a little. Now, when we are determining net profit, we basically go through these respective steps, okay? And from just the format of how a P&L looks like. Of course, we have the sales, okay, which would be there. Then we have the cost of sales. We have the cost of sales, which cost of sales has opening stock. And then we go ahead to add purchases. And then we less our closing stock. Okay. And at the end of the day, we'll have our cost of sales, which let's say will come here and be deducted off this to determine our gross profit. Okay. Or it can also be a gross loss, depending on what you exactly have. And then from there, you have your operating expenses. And then after the operating expenses, you definitely have your net profit or loss, whatever it is. Okay. So that is basically what we do. Now, what I'm trying to basically do here is I want to look at the information I've been provided and see how does it impact my net profit. This net profit that I have gotten, the question has told me that that net profit that I got was before this information. So this information came up after me getting the 905. So I want to see how does this impact my net profit. Should I add back whatever I have here in terms of information, or should I less? Okay. So what I've tried to basically do here, and what I was trying to do within the working here, I was trying to adjust onto what would be my true inventory value. Okay. What is my true inventory value? Now, I also want you to understand something small here. In determining this net profit, how does inventory work? Now, inventory, closing inventory, because we have opening stock and let's then closing inventory. I usually use stock and inventory exchangeably. Closing stock, I'm going to ask you that the higher the closing stock, because closing stock affects our cost of sales, okay? And the higher the closing stock, of course, the lower your cost of sales. And if your cost of sales are low, it means that you have a higher profit, because sales minus cost of sales gives you profit. I repeat, closing stock, how it affects profit. Now, when you have a higher closing stock, okay, it means you have a lower cost of sales, because cost of sales is opening stock, add purchases, less closing stock. So if you're lessing something less, then you get if you're lessing something that is higher, it means that you get let's say a lower cost of sales. And the lower cost of sales subtracted from your sales will definitely give you a better profit, gross profit, which would also finally give you a higher net profit. So in case your assets lost value along the way, because what we are trying to see here is that this is the inventory that we started with, and this is adjusted inventory, okay? So it means that this definitely inventory, of course, lost value by the 2.2. Now, when we were calculating this 905, we basically used what? We used the 545,507. But now we have to adjust. Now, for you, what you may just do is you come here and say, now, the whole judgment here is, should we add back, should we less? Okay, should we add back, should we less? Now, like we are saying, in this case, our inventory is actually doing what? Is losing, our closing inventory is losing value, okay? So it means that our closing inventory is getting low. Now, you just ask yourself, as closing inventory gets low, how does that affect my profit, okay? As your closing inventory gets low, like we said, when your closing inventory gets low, it means that our cost of sales will actually go high, okay? Our closing inventory, okay, when our closing inventory goes low, our cost of sales will go high. When our cost of sales goes high, it will actually negatively affect our profit, because the higher the cost of sales, the lower the profit. Okay, I hope you're getting the principle there. So that means that our closing inventory getting down by 2.2 means that our cost of sales is going to be high. Okay, so as our cost of sales is going to be high, it means that it will negatively affect our profit. Okay, it will negatively affect our profit. Like our profit will go even a little lower. Okay, so I don't know if, do we understand that? Does any of you who is attending this live get my point? Can I just get some people to confirm here if you understand what I'm talking about of the impact? Use the chat box to just confirm of what I'm talking about. In case you're not understanding, then I can demonstrate it a little more. Okay, Jacinta says it's clear. Okay, I'd love to get another person to confirm that it's clear. Yeah, I can now get it very well. Okay, very good. So it means that our closing inventory is we're saying it's actually losing value, so it is getting lower in terms of value. Our cost of sales will increase, and that will negatively affect our profit. So this 905 will no longer be 905, it will actually be less than the difference that we have in our inventory. So it means that when but how to adjust the added information. So what I'm going to basically do, I'm going to less this change in inventory value. So what I'll just do, I'll just link this to here to bring this 2.2, or alternatively, I can actually just do this calculation within here of what exactly I've been given. So I'll just pick, let's say, this amount, because I understand that now you get the principle, or you can just link the whatever you have in terms of this. Sorry. This is 43. Pick it like this. So that is what I'll just basically put in bracket, and definitely I'll put my what? My 2.2. So I'm basically going to adjust my inventory, my profit by 2.2. So do we get it from there? Beatrice, do you get it now? Because that is how it's adjusted. It is less. Like you've seen, I've tried to create two parts of this. I have what I'm adding back, and I'll have what I'm lessing off. So this one ideally reduces our profit. Let me just remove the 3 zeros, since it's a degree of precision of 3. So this will be like 2, to not be, it will be 2,200, which I'm removing from my 905. Okay, so that's how I'm going to basically adjust. So I hope that is clear. Can I just get a confirmation that that is clear of what I've done? And there are no any questions on that, then we can move forward. In the chat box, could you just confirm that that's clear for you? Okay, yes, it is. All right, so that is how we would adjust that. I believe you're going to get it even with the next part of the question. So let's see something here. So they're telling us that purchase returns of 4.5 to a credit supplier were not accounted for. Purchase returns of 4.5 to a credit supplier were not accounted for. Now yours is to go back and ask yourself, this is 4.5. Yours is to go back and ask yourself, if 4.5 was left out in terms of purchase returns, how would that affect me? Okay. So maybe this could be our working tool for purchase returns. And this is 4.5. Yes, it is 4.5. So back to our analysis here on our profit. Now, when you look at this, purchase returns are usually under here. Purchase returns are actually an adjustment on two purchases, okay? Remember, if you have purchase returns in place, when you come and add the purchase here, you have to come and less purchase returns. You have to less purchase returns. Of course, one of the other things that, if in case you have it, is you add what we call the carriage inwards, okay? Just in case you have them, and that's just expounding the calculation of the cost of sales. Now, yours is to ask yourself, just in case in lessing here, they list a lower value because they didn't take into consideration the purchase returns of 4.5. What would that mean to you? Okay, so let's just see something very small here. Now, in case how purchase returns affect. Now, the cost of sales. Okay, let's first look at how purchase. Let's say how purchase returns affect our cost of sales. Now, remember, cost of sales is opening stock, add purchases, less closing stock. It means that the higher the purchase value, the higher the cost of sales. Okay, the higher the purchase value, the higher the cost of sales, because it's opening stock, add purchases. Now, if purchases have purchase returns, it means that your purchases are going to go a little lower. Okay, so the lower the purchase returns go, the negative effect it will have to your cost of sales. Your cost of sales will also reduce. Okay, now as your cost of sales reduce, it means that your profit will improve. We get the principle. Your profit will actually improve when your cost of sales goes down because of the purchase returns that negatively affects your purchases. Definitely your cost of sales will decrease, okay? And that would mean that you have a better profit, because your profit is cost of sales subtracted from your sales, okay? And at the end of the day, even if when they remove operating expenses, it means that your net profit will still remain to be good, okay? So in this case, these purchase returns that they are talking about of 4.5 not being accounted for means that if we deploy them, okay, if we account for them now, okay, it means that they are going to affect our profit in a positive way, okay? They are going to affect our profit in a positive way. So what we are going to basically do is we are going to include here unaccounted for. These are unaccounted for purchase returns of 4.5 for 500. So we shall include it there, and we are adding it there because these purchase returns would decrease the value of our purchases, which would definitely decrease our cost of sales. And decreasing our cost of sales means that our cost of sales are much lower than our sales, which will increase our profits by the same magnitude, okay? So are we okay with that one, with the purchase returns? Can I just get a confirmation from here if you get the idea of purchase returns, if I take a lot of time on it? Can somebody confirm in the chat box? Let's be very active and very fast on this. And in case you don't understand, please ask what you don't understand, okay? So that I'm able to re-explain this for you. Okay, Sandra says she has gotten it. Okay, so at least I get that confirmation. So let's just try to move forward. They are telling us that interim dividends, the 94.50 reflected in a trial balance were paid on 3rd October 2020. Now, when you bring in dates, you use it to first ask yourself, which accounts are you looking at? You're looking at accounts as at end of 31st December 2020. So they are telling us that these were paid on 3rd October 2020, and they are interim. They tell you that directors further proposed a final dividend. The directors proposed a further dividend of 70 shillings 70 per share on 20th December 2020, which is subject to a resolution at the annual general meeting. The directors further proposed a final dividend of shillings 70 per share on 20th December 2020, which is subject to a resolution. Okay. Now, what are dividends? I said dividends are returned to shareholders. Okay, and like we're saying, we have this 94.50 that we have within our books. Okay. Now, they're telling us that this is not alone. We have other dividends that were proposed, and they have something to do with a subject. They are subjected to resolution, which will happen after the reporting date. Okay, we have what we call the events after the reporting date. Okay, like you see, it's subject to resolution at the annual general meeting. Now, you just ask yourself, does this affect my profit? Okay, does this affect my profit? Now, remember, we have what we call profit, okay? And then we have what we call the retained earnings. We have what we call profits, and then we have what we call the retained earnings. Now, once we make profits as a business, okay? Once we make profits as a business, then we go ahead to either distribute these profits to shareholders in terms of dividends, or what we rather do is we retain the earnings, and that's why they are called retained earnings. So yours is to ask yourself, in this case, the retain what they are talking about as an issue, okay, as what they issued basically to this, would it really affect my profit? Definitely, we are not yet at the profit level. Okay, we are not yet at the point of profit, so it would not affect our profit. Rather, we shall basically look at that when we come to the statement of changes in equity. Okay, so I want to first leave that alone and first proceed to the next part of this question, which is saying that at 31st December 2020, salaries and utilities were shillings 12.5, and okay, salaries and utilities shillings 12.5 and shillings 670 were outstanding, were not paid. Basically, outstanding are also accrued. Okay, they are basically your accruals. Now, accruals increase your expenses, okay? Because the double entry for accruals is you debit the expense and then credit maybe the accrued expense account. So if they are saying that salaries, at the end of this, we had salaries of 12.5 and utilities of what this that were outstanding, it means that these in themselves should affect our profit. And how do expenses affect our profit? Expenses affect our profit negatively, okay? They affect our profits negatively. So we are going to less these salaries and utilities under our adjusted profit. So we have salaries of 12.5. So I'll just come here under my salary, under what I'm lessing. I'll say less salaries. Okay, they are saying this is 12.5. So I'll say 12,500 since I have already a degree of precision up there. So I'm lessing my salaries, okay, with the 12.5. Now, the next thing that I'm going to basically do is I'm going to also less my utilities, which is 670, okay? So I'll just come here and say utilities. $670, like that. I hope that should be much clear, at least for everyone. And then they are telling us that rent of 48 million was paid on 1st October 2020, catering for 12 months. Rent of 48 million was paid on 1st October 2020, catering for 12 months. Now, yours is to ask yourself, when is this period ending? This period is ending 31st December 2020. Okay, so they paid rent on this on 1st October, and it's catering for 12 months. Now, in that alone, you have what we call a prepaid rent. Okay, you have a prepaid rent component. And what happens with the prepaid rent? How does that affect your profits? Okay, now if they are telling us that rent was of 48 million, the prepaid rent is paid of 48 million. Let me just come here and just try to put working 3 here. So if I have prepaid rent, it is 48 million, okay? And they're telling me that this was paid on 1st October 2020, and it is for 12 months. So what I'll do is I'll first calculate my monthly rent, which will be 48 million divided by 12, which gets me to 4 million. So 4 million is my monthly rent, okay? So it means that rent to be recognized for the year is basically this 4 times. Now, if we pay rent, 1st October. 1st October is, let's say, that is 1 month, October, November, December. Yes, they are basically 3 months. So I'll recognize rent for 3 months, which is 12 million. Okay. And prepaid rent, that means it relates to the next financial year, will be basically from January, the remaining, because I've only recognized 3 months, October, November, and December. So the remaining 3 months, which is 9 months, will definitely be my prepaid rent. 36 million. So what does this mean for my question that I have at hand here is that I'll go ahead to make an adjustment, okay? Now, prepaid rent, and I want to beg your attention here. If you have rent and you have a prepaid amount, okay? Now, the prepaid amount of rent comes to reduce the rent value, okay? So it means that it reduces your expenses. Prepaid rent reduces your rent expense. And what does that means? That if you have fewer expenses or low values of expenses, it means that your profit will do what? Your profit will improve. So the higher the prepayment, the higher the improvement in profit. Okay, from that principle. So it means that this 36 million, if we have been able to identify it here, it needs to be added back, because it means that we would have a better profit than what we reported earlier on because of this prepayment. Because like we're saying, the higher the prepayment, the lower the expense, and it means that lower expenses give us a higher profit. So it means that the 36,000, I'm actually going to add it back here. So I'm going to just come here and say prepaid rent, which is 36,000, which is basically 36 million. So that is what I'll basically do. Now, somebody will ask myself, so what do you do with this that has been recognized for there? By you being given this additional information tells you that already, remember, we already have, when you look through our trial balance here, we already have a rent amount. So let's just see if we have a rent amount. Okay, I don't seem to see rent. I don't know if that was recorded. Okay, I don't seem to see basic. Okay, the reason I think why rent has not been showed is because it's part of the net profit. So it is part of the expenses. You know, they have given us the net profit. So by giving us net profit, it means that some incomes, that's why you're not seeing things like sales, purchases, and so on. They have only given you the net profit. But sometimes they include rent within your trial balance. Okay. But here they have only summarized all the expenses as well as the liabilities. Okay, no, expenses and incomes to give you the net profit. So that's why you're not seeing it here. But ideally, it would have been basically there. So you only make the adjustment. Every time you give an information like this, you only make the adjustment when it comes to the prepayment. Okay. So that is what I basically did. Now, the next thing we also have here is that non-current assets were depreciated as follows. The non-current assets were depreciated as follows. Now, in the same way they are telling us here, remember they are telling us that the assistant accountant determined the net profit reflected, but had not taken into consideration the following information. So it means that even the net profit we have didn't take into consideration this depreciation. Okay, everything that is down here. So we need just to take into consideration and go ahead to do what? To depreciate our assets. Okay, so we have been given the information for depreciating our assets. So we should be able to depreciate it given whatever we have. So I'll just come here, maybe my working for, and say depreciation. Okay, so I have my depreciation rates there that have been given. So this one is more 12.5% on cost. So it means that if I'm calculating my depreciation for this one, what I'll just do, I'll just say depreciation is equal to 12.5% times what? Times the cost. So I'll go and look for the cost of this motor vehicle, and it has been provided up. So I have motor vehicle at cost. So this is what I'll pick, the 230,504. That is what I'll pick and put right there. Okay. So after that, I can now be able to determine my depreciation in terms of value. What this will be. All right, so that's what we basically still have. Okay, so we have 28,813 as our depreciation for motor vehicles. So I'll just come here. Now, depreciation, what does it do on our profit? It reduces because it's an extra expense. So I'll just record depreciation. So I have motor vehicle. So I'll just pick the amount. It's 28,813. Already the degree of precision is in it. Okay, right there. So that's what I'll have. Then I'll now move to computers. Depreciation will equal to, now computers, it is 25%. So this is 25% times the cost. So I'll just go and look for the cost for computers, which is basically, let me see, computers at cost is 65,400. So I'll come here and say 65,400. So 25% times 65,400 gets me 16,350. Then I have now 20% on reducing balance. So it means that for this depreciation will equal to 20%. Now, since it's on reducing balance, what I'm going to basically do, I'm not going to multiply by cost, but rather I'm going to multiply by what I'm going to call the accumulated, okay, I'm going to get my carrying amount, which is also called the net book value, okay? So I'm going to get my cost less accumulated depreciation. And that is how the formula of reducing balance method works, okay? Instead of subjecting this at cost, we subject it at the net book value or the carrying amount. So I'm going to substitute this accordingly. Let me just try to check out from the question and see. We have computers, okay, plant and machinery at cost. Cost is 345,650. Okay, so I'll take my cost and put it there. And now I have to less, I will less accumulated depreciation, which in this case has also been given to be 103,695. Remember, this is the accumulated depreciation at the start of the year, because remember, we're just calculating the depreciation for this period. So you take the accumulated depreciation at the start of the year, okay, which gives you 20% of that. If I'm to bring this into the formula, if I'm to do this and this, it will, let me just see, 20%. Okay, let me just try to see. It gives me 48,391. 49,391. So I'll just come here, plant and machinery, under depreciation, and I'll be able to put the value there, which is 48,391. 48,391, right there. So that is what basically I do have. So mine is to go back and check and see if I've expounded all the assets that I have. So yes, I've been able to depreciate the assets and been able to adjust my profit. Then the next thing they're telling me that the loan was acquired on 1st October 2020 and interest was outstanding. So remember, we only had one loan in our trial balance, which is 18% loan repayable by 2027, okay? This 18% that starts here is usually the interest rate. And so what we are going to do is we're going to calculate the loan interest, okay? Which will definitely be the 18% times what? Times the 300,000. That is what we are going to basically do. So I'll just come here on my working, maybe this is working 5, and say interest, which is 18%, times the 300, it's basically 300 million because of the degree of precision there. When I do this, this gives me about 5.4. So this is annual, okay? This is annual. Annual interest. But I want you to see something small here. This loan was actually gotten not at the start of the year. The examiners told us that this loan was gotten on 1st October 2020. Now, 1st October 2020, if your financial year ends 31st December 2020, it means that you have the month of October, November, and December. Those are 3 months. So it basically means that from what you have, from what you've calculated as your annual, the interest for 2020, meaning that October to December will basically be, I'm going to get the 3 months divided by 12 times the 5, 4, basically this times the 5, this is 5 point, I think it's basically 54 million times 54 million, okay, which gets me to 13,500, okay. So that is my interest for the 3 months. So interest reduces your profit. So I'll just come here and put interest, and I'll actually put 13,500. And that's how I would have calculated my interest, okay? That is how I would have calculated my interest. So with that in mind, mine is now to proceed and see if there's anything else that I have not put into there. So they're telling us that sales include a deposit of 3 million cash received from a customer on 4th November 2020 for goods that were delivered on 14th February 2021. Okay, I'm going to say it was me that I didn't record computers. Okay, thank you so much. Let me just try to record them here. I think I calculated them. I hadn't recorded this depreciation for computers. Just recorded. It was under the category of depreciation of what? Under the category of depreciation. So that right there. Okay. It's 16,350. Yeah. So interest, we have recorded that. Then the next one that I'm now looking at is the sales issue. So sales, they're telling me that sales include a deposit of 3 million cash received from a customer on 4th November 2020 for goods that were to be delivered on 14th February 2021. As you can see, the delivery date is after the our financial year end date. So it means that these goods, basically the sales in regards to these goods relates to the next financial year, which is the financial year of 2021. Okay, so that is why I've been able to come here and be able to record what I'm going to basically do. I'm going to exclude this 3 million from my sales, okay, because this 3 million is not valid to be part of my sales that have been recorded. So what I'm going to basically do, I'm going to come back to my analysis here, and I'm going to ask myself, how do sales affect my what? My profit at the end of the day. The higher the sales, the higher the profit, okay? Every time sales go down, it means that my profit will also do what? Will go down. So in this case, since we have a 3 million sale that is supposed to relate to the next financial year, these sales are basically called, this is like a deferred income, okay? This is like a deferred income. So this 3 million, basically we have to negatively adjust on our profit. So the 3 million also has to be less onto our on what we have. Okay, so we have to come to there and be able to less those deferred sales. I call them deferred sales of 3 million. Okay, so that is what I'll basically do have. So after that, they're telling me that the estimated tax for the period is 325. The estimated tax for the period is 325. Of course, how tax affects profit, it affects it negatively. Okay, so I'll go ahead to include the tax for the period, that value that I've been given, which is basically 325 million. So I'll do 325,000. Okay, so I'll just come here, estimated tax for the period is 325,000. That is what I'll basically do have there. Once I'm done, I'll now get my net profit called adjusted net profit. Okay, so okay, what I'll do before that, let me just try to get the summation of whatever I'm deducting. So I'm deducting this summation of 450. Then I'm also adding back about only 2 items of 4, 5, and 36. Okay, 4, 5, and 36. That is what I basically do have. So just my adjusted profit will definitely be what I started with. Then I'm going to add what I'm adding here. Then I'm going to less what I'm deducting, the total of what I'm deducting this. And it's giving me 495,076. Okay. Now, as you can see, this is a lot of space that I had created. I thought I had more items to add, but unfortunately, there are very few. So you can be able to use a line and cancel this space. Alternatively, you have nothing to be penalized in case you didn't divide it in this. What you would basically do, you would do item per item. You could just leave out this thing of add back, because you may not also know how much you're going to. And what you just do is whatever you're adding back, you just say, maybe make it a positive. Okay, whatever you're lessing, you can go ahead to put a negative, okay, onto it, so that at the end of the day, the examiner can know that this one is being less, this one is being added, and so on by those formula. Maybe that one would be much simpler to you, but it's the same principle. Definitely, it will not take you any challenges. Sorry, it's supposed to be negative. Yeah. So at the end of the day, you can just basically do sum up this, all of it with the negatives inclusive, and you can basically still come to the 49,576 right there. So that is what the examiner basically wanted you to calculate when it comes to here. Okay. Yes, just look at the last question. Second last question. So they wanted us to draw what we call the statement of changes in equity. Now, a statement of changes in equity is also one of the statements, the financial statements that we do have, okay? And what the statement of changes in equity basically does is that it helps you to understand how your different elements of equity have changed throughout the period, okay? Basically, statement of changes in equity looks at equity items, okay? It looks at equity items. So I'll just draw, just use this opportunity to just draw for you how your format would look like, especially for this question. So should I use this? Okay, let me just try to want to use something that is a bit okay. Okay, so just like any other account, of course, the statement of changes in equity will also have, it will have what? It will have a heading. Remember, this is Kilonge Limited. So you give it your heading. You give it your heading and say, I want, okay, Kilonge Limited is statement of changes in equity. Okay. Now, you want to, of course, this is for the year ended 31st December. For the year ended 31st December 2021. Okay. And this definitely, now statement of changes in equity, like we're saying, it looks at equity items. So in most cases, it will have, let's say, a detail column. It will have a details column. And next thing that it will have, it will always have each of the items of equity with a column for itself. Now, if you want to determine which are your items that are of equity, like the items, the equity items, yours is to come here. Anything that falls under equity, like share capital, would have a column. So our first column will basically be the share capital column in our statement of changes in equity. So we'll have a share capital right there. Now, the next part, of course, definitely we shall have is the share premium. We shall have the share premium column, share premium. Now, the next thing that we also have is revaluation reserve. From the information we've been provided, we're seeing that we have a revaluation reserve. It's also an element of equity. So I'll put revaluation reserve within our another column. Okay. Now, apart from that, there is also the retained earnings, okay, which in this case, the examiner called retained profits. So yes, of course, it's okay, we can call them retained profits, but they are retained earnings as well. So you also have that column. So basically, each equity item has a column on its own, okay? And that is how everything runs. So once you have that, you can be able to have that. You actually also have your total column. It's good for you to have the total column here, okay? Which I would also just try to do. As simple as this, okay? In most cases, what happens is that you may find that if it's a small company, small companies don't have things like share premium, revaluation reserve. They'll have, let's say, capital, which will not be called share capital, but it will be capital, and then to have retained earnings. At least every company has capital, and then it has retained earnings, and that will be all. So depending on which company has what, other items that you can also have here, other columns like general reserves, just in case you had them, they would also form part of your columns. Any item of equity would definitely form part here, okay? Now, the first line that we start with is our balance brought down. We start with balance brought down. So balance brought down is what we start with. Just write this in small letters. Basically, what you have started with at the start of the year. So this balance brought down is at 1st January 2020 at the start of the year. So you come and put all your balances for each of these items at the start of the year. And all that information, you can basically get it from the information that the examiners provided. This is the retained profits The balance at 1st January 2020 is that. So I'll come and put it there. Retained profits, I come and put the amount. So what I'll basically do, since these amounts are in thousands, you can include the degree of precision of thousands here, or I can just include it on the heading here. And I say that these amounts are in UJEX, 3 zeros, okay? So that it represents everything. So basically that. Then I'll come here and say my share capital. So they have given me my share capital, which is this. So this is what I'm going to basically record the other side for share capital as balance brought down. So I'll just come here and the share capital and record that value, okay? And then what I'll basically do is share premium. Share premium also, I'll just go back to what I have. Share premium is 445 that. So I'll just come and update the share premium value as well. Okay. And then also the other thing that I'll also go ahead to do, update the revaluation reserve, which is 76,540. I'll come and update revaluation reserve. So that is what I basically do on a statement of changes in equity. Okay. Now, after I've done that, mine is now to come and recognize whatever has happened within the period. Okay. Now, one of the things that happened into the period was the profit. So the next thing that I want to do is record the profit for the period. The profit for the period, okay, ending December 2020. So the profit for the period, we already calculated the adjusted profit. I'll come and just pick it here and record it. Now, profit for the period is recorded under retained earnings. Okay, remember profits increase the retained earnings, so I'll record it under here. Now, one of the things that you need to know that every time you do that, you also need to get the total for each of the rows. Okay, just a moment. I'm just trying to add the total of these items, which is this. Then I'll also get the total of this. I'll get that total right there. Okay, like that. So for each row you add up. Okay. Now after the profit, the next thing you need to also look at are your dividends, because once a business makes profits, it chooses to give some amount of money to in terms of, let's say, in terms of dividends. Okay, so we are going to look at the dividends that were issued out. So from the information, if you remember, we saw that we had dividends somewhere. They told us that they had paid dividends worth 950. Okay, so I'll just come and say dividends paid. Dividends paid is 150. Is it okay? It's actually 9,450. Now, the additional information also had something to do with proposed dividends. They had told us that they had told us something here. Where? They told us that they plan to, okay. Interim dividends reflecting trial balance were paid on this. Directors further proposed the final dividend of this on this, which is subject to resolution in the annual general meeting, which is on May 2021. So this one is, these are basically proposed dividends. What we only do with them is we do disclosure. We just disclose them in the accounts, but they are not yet valid dividends. Okay, so that is what would basically happen there. So yours is to ask, once you've put your dividends there, yours is to find out and see, is there any item that I have left out when it comes to information here? Now, just so you know that this is supposed to be a negative because they are dividends paid, okay? They're not like profit. So what you do, in case there's nothing else that relates to this, in case there was another revaluation, we definitely adjust this. In case there were more, let's say, more shares that were issued, we'll definitely include here, but we don't have any information in regards to that. So what I'll just basically do, I'll just get my totals on the different lines, because the total of this would definitely be this amount. I'll just cascade this here. And definitely the summation of this is actually 2189, okay? It is basically the overall equity value is 218963. So this is how the statement of changes in equity will definitely look like, okay? This is your total. Definitely the total here would be the total here, okay? And that's how it will look like. So it's not complicated. Whenever somebody asks you for a statement of changes in equity, it's not really something that should really really disturb you, okay? Do we have any questions on the statement of changes in equity? Could you just type in the chat box just in case you have any questions on the statement of changes in equity before I can proceed? All right, so I don't see, somebody asks what is revaluation reserve? I said revaluation reserve. Usually this comes in after revaluing your assets. And I explained why you may revalue your assets, because their value, their book value, okay, may be way lower than the market value. So with that, you have to revalue your assets. Every time you revalue your assets, you debit the assets and then credit your revaluation reserve, okay? So this amount is kept within your books as a revaluation reserve. So that is what exactly happens. I proceed to the last part of the question so that we can close the day. The other one is they're asking you to prepare the statement of financial position for this entity. So that is one of the simplest things that you basically do, since you already have most of the information. Now, so you know that a statement of changes in equity will always be prepared before the balance sheet or the statement of financial position, because the reason why we do that is because the values that you've gotten from your statement of changes in equity are values that you need to be able to use when you're preparing for your statement of changes in financial position. All these values down here, we're going to use them here, okay? And remember, this is called, we say as at 31st December 2020. That is what we best thought that, okay, this was 2020. It was not 2021. We just try to change it like that. So we know that when we are preparing our statement of changes in financial position, basically we look at assets and liabilities, okay? So what I'm going to basically do is I'm going to start with my assets. So assets, and assets, I'll start with my non-current assets, which another person might call the long-term assets or fixed assets, okay? And for non-current assets, I usually look at costs, and I look at accumulated depreciation. And then I'm also able to get my net book value, okay? That is what I basically do right here. So from the information given, I'll go ahead to look out for which assets do I have. remember we have the motor vehicle, machinery, and computers as provided here. Okay, so I'll just try to copy a little of this so that we can speed up this information. So those are the three assets that I have. I remember also seeing land, so land will also come in here as well. Okay, so I'll pick their costs. I already have their costs from my calculations right here. Remember, I was trying to calculate. Okay, this is the cost of the motor vehicle. So I'll come and record it here. And that also reminds me of putting the degree of precisions, UJEX 3 zeros. Okay, it's very important that you don't forget that you don't confuse the examiner. Okay, so accumulated depreciation, usually they have provided you usually they have provided you the accumulated depreciation. Okay, but the accumulated depreciation they have provided to you is at first of the period. So yours is to get this value. Okay, yours is to get this value and add the depreciation for the period. Accumulated depreciation, if you want to update it, this is for the start of the year, but if you want to get one for the end of the year, you get with what you started with and add the depreciation for the period. Okay, so what this would basically mean is you would come here, if this is motor vehicle. So this is what I started with, but I'm going to adjust this. So I'm going to do here for me, since I'm using Excel. So I'll just get that and add the depreciation for the year. Remember, the depreciation for the year we had for motor vehicle was 23. 28 is 28,813. We calculated this depreciation from, remember the working we had, we calculated it right here. This is the depreciation. So you need to be able to understand that. And then from there, once you have that, you can find your net book value, which is this minus what? Minus that, which gives us 86,439. So I'll do the same thing for the computer. I'll just basically come here and pick, this is 16,350, press my calculator, and I'll come right here and okay, let me first pick the cost. I've picked the accumulated depreciation. Let me first pick the cost. So for the computer, the cost is 65. So I'll definitely pick the 65 right there. Then the accumulated depreciation, like I said, I'm going to pick the 16,350 and add the depreciation for the year. 16,350, 16,350, 16,350, and I'll add the depreciation for there, which was it was actually the same. It was the same one. It is also 16,350. So I'm still going to add 16,350, which gives me 327. So if I'm to get the difference there, will be 65 minus 32,700, which gives me 32,700. Okay. So I'll do plant and machinery. And for plant and machinery, I'll just come here, look for the cost of plant and machinery, which is this value. I'll take it there and write it accordingly. Then I'll get the accumulated depreciation for this, come here, which is 103, and add the depreciation for the year. Okay, so I'll get this 103 and add the depreciation for the year. For this, it was 48,391. It is 48,391. 48,391. 48,391, which gets me 152,086. So when I get the difference, this minus this gets me to 193,564. That is what I basically get. So what I need also to do is check out for land. Land at cost is 520. Land does not depreciate, so I'll take the value as it is. So land, I'll just take it in the column of net book value right there, okay, as we can see. And from that, I can basically do what? Okay, its cost is the same. So maybe you want to put the cost here. Of course, depreciation is 0, okay. And from that, if all that is your non-current assets, then you can find the total, okay, and call it total non-current assets. So I hope you're also doing this on your side. I usually love it when my students are following me as they also try to think through these things. I know sometimes I may do these things a little speedy since I'm using a computer, but you might even do these things a little faster. So I'll go to my current assets now. Okay, and with my current assets, main is to look out for what are my current assets. What do I have for my current assets? I was given cash and bank. Okay, so I have cash and bank, and then I have inventory. But remember, if that inventory had an adjustment to it, so I'll first pick cash and bank, then come back for the inventory. Cash and bank, it is 1111 that. So I'll just pick that value. Let me put it in under that column. And then the next thing that I'll do is go for inventory. Now inventory is 45507. But remember, this inventory had an adjustment. Remember what we adjusted with inventory at the start of this question. We say that our inventory had lost value and its current value was now adjusted to 543,307. So that is the value that I would definitely want to work with, just like the way I adjusted my profit. So this is inventory. I'll put it there. Now, just in case there was also some information that would affect your cash and bank, you definitely also have to come and adjust it. Okay, I'll remove these 3 zeros so that it remains 43,307. So that's what I have for my inventory. Okay. Let's just look through this information and see if we have expanded. So we have inventory and we have trade payables, then we have investments. Oh, okay. I just left out investments. Now, investments is mostly classified under non-current assets, because in most cases, these investments, you'll be able to earn from them in a period that is more than 1 year. Okay, so they are usually recorded under non-current assets. So just allow me add just a column here and include them. Okay, since I'd left them out. So investments are very key under your non-current assets. So I'll just try to adjust them. I missed it out. Investments. So it's supposed to record it there. So it means that this will even adjust my value to a match. Okay, so it adjusts this to about 2839. Okay, so
with that in mind, what I'll basically do is I'll now proceed again. In most cases, if this is my last question, I'll even tick them up, anything that I record. Trade payables are recorded under my liabilities. Allowance for bad debts, not for now. Share capital, share premium, I've recorded now. The next one is trade receivables, okay? So I'm going to record my trade receivables as they are provided there. As you can see, it's 402, 160. So I'll just come here and say trade payables, trade receivables, sorry. Like I said, trade receivables are debtors, and debtors are definitely current assets. So I'll record them there. And the next thing that I'll also do is I'll still come here and look out for any other current assets. In case you see any, you can let me know, that I can be able to include it as well, okay? But what you need to basically know is that trade receivables are adjusted by what? They're adjusted by the provision for trade receivables. Every time you have allowance for bad debts, whenever you go to your trade receivables, you have to adjust them. Now, how these two are related is that allowance for bad debts are introduced when the organization thinks that part of their trade receivables will not meet their obligation, okay? So for matters of prudence, of not overstating our figures, we go ahead to adjust our trade receivables in the statement of financial position. So trade receivables are supposed to be adjusted by this value. So we have to adjust our trade receivables by that value, okay, to determine the new value of trade receivables, okay? You can even choose to do this in this column and then just have your, what you can call your net trade receivables or adjusted trade receivables, whatever thing you might call it, okay? Which is 35,780. That is what you basically have. Now, you also need to remember that one of the additional information that they provided to us, there was an additional information right here that had a rent. We had rent that was of 48 million that was paid on 1st October and was catering for 12 months. When we are trying to do our working, we also agreed that when we are recognizing such rent, we have some rent that will be recognized for there, and then the 36 million needs to be recognized for the next period. Now, prepaid rent in its own is an asset, is a current asset to the company. The reason why it is a current asset to the company is because you have paid this amount of money and you utilize it in the next financial period, okay? So ideally, you need to recognize it as part of your current assets because you benefit from it in the next period. So I'll have my prepaid rent as an additional current asset right here. So I'll just use 36,000, like that. That is what I'll basically do use, as you can see there. So mine is just to confirm that I don't have any other, let's say, maybe anything that I've left out, okay? Please, Rosemary, don't unmute yourself because it's distracting the class. So if that is all that I have, I'll get my total current assets. Total current assets, which okay, this is 5507, right there. So after that, I'll have my total assets. I'll have my total assets, which is the summation of that and that, which gets me to 2,939,890. That is what I basically have as my total assets for my information. Now, the next thing that I'm going to look at also, equity and liabilities. Equity and liabilities. So for equity, now the reason why we drew up whatever we drew up, I know we drew up our statement of changes in equity. Before I can proceed, please, Rosemary, every time you unmute your microphone, there's some sound we get. So just mute it. In case you have a question, use the chat box. Yeah, I mean, Nagai Rosemary. Thank you. So I was saying that the reason why we drew up our statement of changes in equity is that these balances, as you have them, is the way you bring them to your statement of financial position. So I'll just have share capital, share premium, evaluation reserve, retained profit, and include it under under down there, those balances. So that is why we prepare up this account. Okay, so that is what I want to bring here. So I'll write share capital and come and pick the amount. So I'll just come here under equity and liabilities. Of course, I'm starting with equity. So I'll just pick share capital and then come and what? So I don't have to go back and again look into the information because I've already calculated the balance that is latest here. So that will be the value. Then I'll come to the next one, which is share premium. And I'll also, the reason why I'm just speaking this, just in case there were any adjustments in the additional information, they should have been taken into consideration at this level. So I'll record that one as well. Then I also come to, I'll come to the revaluation reserve. Evaluation reserve. Which is 76,540. I'll record it there. And then I'll say 49,166 is actually retained earnings. So this is retained earnings. Sorry, let me just try to do this. Call this retained earnings, or what you might call your retained profits. Okay. All right. So the other one that I think I've not brought up here. Okay, I've brought retained and evaluation reserve. Everything I've really brought it up here. So what I'll basically do, I'll get my total equity, which definitely matches my total equity that I got the other time. Then I'll come to my liabilities and I'll start with non-current liabilities. Remember the loan we had? So that is the one I'll start with. I'll come here. And say the loan was acquired on 1st October 2020, and interest was outstanding. Definitely the loan itself is a liability, which I'm going to record under my non-current liability. But when I also come to my current liabilities, I'll also be able to record the interest as well. Okay. So this is, you can just call it the way it's called, 8%, 18% loan. I'll record the amount, which is 300,000. Okay. So the next thing that I'll also do is to check and see, do I have any other, let's say, non-current liability? In case I don't have any, I'll move to my current liabilities. Okay. Now, for me to record this easier, I'll start from what I have within my trial balance. Remember, I have trade payables. Okay, trade payables, is it the first one? Yes. So I have trade payables worth this value. So I'll just take this here. Trade payables, which is 100, that Okay. And then one of the things that I also do is I'll come here, investments, all these have recorded it, land at cost and so on. All these have recorded it. So the next thing for me to think about is there another liability? Remember what I talked about when you come to down here. Let's just look at the additional information and see if there's any liability that came through. Not that one, not that one. So we have these where they're telling us that salaries, utilities remained outstanding. Now these are liabilities, okay? Since at 31st December we hadn't paid them, they're actually liabilities. So just as I recorded them when I was recording my, when I was adjusting my profit, I'll just pick them for matters of time. So I'll just pick utilities and salaries. These are outstanding. So I'll just bring them here. Sorry. I'll just bring them here. So I'll call them outstanding. It's good that you separate the name. Outstanding. So I hope that is clear for you. Outstanding as well. So this is 670. Let me just remove this here. It's negative. So those are liabilities in themselves. The next one that I'm also going to record, this was a prepayment, I recorded it. This one, the interest that was outstanding. Remember, we calculated that interest somewhere. So since it was not paid, I'll just look for it in my working. Interest was 113,500. So it's one I'll still record. Okay, only what relates to the period ending that financial year. 13, I'll remove the 3 zeros, 13,500, and call this interest outstanding. Outstanding, like that. So that is what I basically do have. Okay. Now, one of the other things that you also need to think about is here. They're telling you that a sales include a deposit of 3 million cash received from a customer on 4th November 2020 for goods that were to be delivered on 14th February 2021. Now, the deferred sale, okay, this money that you've received in advance is also a liability to you because you've not delivered goods. So in any way, you have to meet this obligation in the next financial period, okay, by delivering the goods. So it's one of the things that we also record out under our liabilities. So just as I recorded my deferred sales when I was adjusting my profit, I'll just bring it here. The deferred sales or deferred income. Deferred income actually is a liability. So this is 3K. This is 3,000. So I'll just bring this 3,000 here, right here. So 3,000 deferred sales right there as a liability. So mine is to relook through back into the question and see, do I have any other liability that I've not recognized? Now, one of the things that you also need to recognize is there is a estimated tax for the year. And remember, when we are calculating our profit, we actually included it. So this would also form part of your liability, okay, which is a tax payable. So I'll have also within, it is under your current liabilities because you're going to pay it within a year, okay? So tax payable would definitely be 32530, okay? Which is that. So yours is again to go back, since this is your last item, to just check through and confirm that you've included all your liabilities, okay? And what you may want to just do here is add up and see if your think balances. If it doesn't balance, then that is an indication that is something that you might have left out. Okay, so I'll just get the total. Okay, let me first get total current liabilities. Total current liabilities, which is the summation of this, like that. So then I'll have the last line, which I'll call my total of equity and liabilities. So this one, I'll add this plus this plus this, which gives me 2,944,390. So this gives me, this is 2,944,390. Okay, so ours is just to confirm that we have written the right figures. The tax payable 325,000 and the 3,000 is okay. The 13,500 for interest was okay. As per what we had, 670, we recorded it. 12,500, and then we have okay. There's something that when you look at here, I want to I think that even helps you to when you're trying to review. There's something here that we didn't take into consideration. Actually, when you get the difference, sometimes sometimes when you get the difference between what you've gotten, if this is a balance sheet, it will give you an indication of what you might have left out. Okay, so as we can see, what we have left out is 4,000. What is the difference? Is 4,500. So yours is to go look around for your information, either here or even up, to see is there anything that is valued at 4,500 that I've left out. In case you can't find any, you have to go there. But when you look at there's something here where they told us that purchases, okay, there are purchase returns of 4.5 to a credit supplier that were not accounted for. Now, when you return purchases, okay, when you return purchases to and they are calling them a credit supplier, okay, when you return your purchases, it means that they will affect what we call your trade payable. The amount that you would have paid in terms of trade payable would reduce, because the double entry is we definitely debit our trade payables, because trade payables are liabilities, and when liabilities are decreasing, we debit them, and we do credit our purchase returns. Okay, so in this case, what we have to basically do is adjust this on our trade payable. So the trade payable we recognized here, the one that because the one we have here came as a result from our trial balance. But since there was a purchase return right there, I'm going to just put here in bracket less the 4,500 for the purchase return. Okay. Okay, that is what you have. So when you reduce this by 4,500, because it's no longer they no longer have to demand us this, it actually gets us to 2,939,890, which basically matches our 2,939,890. Okay, so that is how you would basically go about that. Just wanted to make sure that I explain that for you as well, so that you don't miss it out. Okay, so I hope this has been helpful, and I hope you've been able to pick one or two things. Yes, the best way to learn is to close your eyes now, close your focus on the recording, and redo this number on your own, by the way. Okay, and in case you have any difficulties, you now go back to the recording and be able to see what exactly you missed out and some of the explanation attached to it. Like you're seeing, every figure I record, I explain why I've recorded it. So you at least have a recording that can explain to you, and just in case anything was not clear in this session, I'm always available to give you extra support onto that. Just post your question on the WhatsApp group and I will be able to support you accordingly. Okay. Yeah, so I look forward to having you in the part of the next class. I wish to remind you that our outstanding balance is due, the last installment for those that paid only a half is due on the 15th. So if you have this money, please make sure that you pay. I think if you've only paid less than 100,000, the only class you have for you is the one on Tuesday, and then I think Sunday. Starting from 15th, then you'll not be able to access any of the classes. So you would love to be part of this as we study and see how we can pass this paper. So try to look for the funds and be able to support us also as we support you. So thank you so much, and wish you all the best. Bye-bye.